1:30 p.m. in Lagos, same time in Accra, Ghana, Nigeria. Lagos, we're bringing you markets, analysis, and insights on business incorporated live from Channels Television Lagos. And here's what's coming up on the program. South Africa's employment rises above pre-COVID levels. And Israel gas flows to Egypt set to return to pre-war levels. And reports show that over 50% of minimum wage earners in Nigeria spend all of their earnings on food. Hello and welcome to the program. I'm Will Ibong. Let's kick off with the markets as usual. First up, we move on to major equities in Africa. We're at intraday. Nigeria and South Africa were trading in the green. Nigeria up 0.24%. South Africa, on the other hand, 0.84%, nearing that 1% level. Egypt, let's see how the EGX30 was at intraday, 0.17% up. Very good for the index, inching closer to the 24K level. And Kenya closed Monday's session in the green as well. Now let's see how the Middle East performed at intraday, mostly negative at intraday, if I may say. Let's see Abu Dhabi down 0.08%, Dubai also down 0.19%. Elsewhere in the region, Saudi, let's take a look at that. Saudi, the only gainer in that region, up 0.62%, while the Qatari index was massively down at intraday, 1.39%. Now, the number of companies falling into insolvency in England and Wales has jumped again. And this appears to be a worrying sign. And we're going to be talking to our correspondent in London, Juliana Olayinka, to give us more insight. Juliana, good afternoon. Is this something people, companies should be worried about, or the governments?
Good afternoon, Will. Absolutely. I think it's a really tough economic environment in the United Kingdom at the moment. Of course, we've got high interest rates, all of the data that's coming out of the Office for National Statistics at the moment, whether we're looking at construction, manufacturing or services, to show that output is falling. And of course, this is affecting businesses, which is why, as you say, according to data that we just received this morning from the insolvency services, last month, insolvencies in this country jumped by, I believe, about 7% year on year, showing that over 2,315 firms registered insolvencies. Not only are these kind of small to medium-sized enterprises, which we know for any decent economy is the engine room of growth, but also some big firms. I'm sure you remember, Will, we were discussing pretty extensively the issues that Wilko had. Wilko was a retailer in the UK, well, still is. I think their intellectual property is still very much alive, but they were hiring thousands of staff, and thousands of them have lost their jobs because it's very difficult for them to compete with online stores such as Amazon and others. So when we talk about insolvencies, we're not just talking about the stores or the shops at the end of your road. We're talking about some really big firms. And of course, if you think about what's happened over the past couple of years, just immediately after the pandemic and during the pandemic, lots of businesses were offered pretty substantial support from the government by the way of the retention scheme, otherwise known as furlough, or some of the COVID grants. That's not existing anymore. And as I think we get into the colder months and we get towards the end of the year, it is going to be quite difficult for companies to reel back some of their lost earnings. So I think a lot of economic observers in the UK are expecting some of these insolvency numbers to unfortunately appreciate.
It's quite a sad tale of events there, Juliana. Over 2,000 companies, I don't know, going into insolvency. We just hope that it turns around pretty quickly, or their policies to be able to get back, into the economic grind. Now, we see the UK's iconic West End is acting as a test ground for Broadway investment. I think that's one way for people to put their money and at least get some investments or return on their investments these days, Juliana. Isn't that right?
Interesting story. It's a unique report, actually, which has been compiled by CNBC, basically looking at London's iconic theatre land, which once again has struggled. It really struggled during the pandemic, of course, because the world was locked down. And so typically during certain months, we'd expect millions of tourists to flock to see some pretty iconic world-leading theatre productions. They were just unable to do so. So they've lost significant amounts of funding over the past couple of years, but there has been some data out, I believe it was released last week, showing that theatre show production visitors are up. I think they're up year on year by about 9.2%. So according to the data that I had a look at this morning, about 6 million tourists came to see some shows in London's theatre land over the past 12 months, which is a good thing because, of course, we know that that brings so much investment into the UK. The UK economy is put up by services. In fact, services, which include hospitality, of course, contribute about 80% to the UK's economic growth. So it's absolutely fundamental that they're able to invite tourists in and that they go and they patronise some of London's theatre land. Now, we are in the critical quarter, the golden quarter, the quarter where British businesses are hoping to reel back some of their lost earnings. And I think that the UK government, particularly the Cultural Ministry, are hoping that, you know, London's theatre land is going to be the bedrock of inviting visitors back into London as we get into December, where, of course, that final GDP data is going to be absolutely fundamental to ensure that we don't enter into a recession. It feels like we're in a recession. All of the data we're looking at the moment, unfortunately, we're looking in the rearview mirror, so we're not exactly sure what's happening at the moment, but we know consumer confidence is low, business confidence is incredibly low, but yes, fingers crossed that as we get into the Christmas months, I don't think it's not too early to mention Christmas now, Will, because we are getting into that period that, you know, certain sectors like the West End are going to be utilised to kind of bolster up the UK's economic output.
Definitely, Junior, and a lot of shows going to be out there, and people would want to, you know, pour in to, you know, watch and spend their money. So let's see how that, you know, plays out for the economy, especially now that, you know, lots of Christmas gifts needs to be, you know, given out to children and friends. So what are markets reacting to at the moment at intraday?
But of course, we can't avoid the big story at the moment, which is the Rishi reshuffle, which has caused lots of headlines here in the UK. The fact that Suella Braverman, former Home Secretary, is out, has been replaced by the former Foreign Secretary, James Cleverly, and the fact that we now have Lord David Cameron, the former Conservative winning Prime Minister, as Foreign Secretary. That is an unprecedented move, which has certainly rattled markets at intraday. How is this going to work? We've already had concerns by the Speaker of the House, Sir Lindsay Hoyle, about how MPs across the benches are going to be able to call him to account. Because, of course, if you're a peer and you sit in the House of Lords, you're not supposed to be questioned by MPs because that's a higher chamber. It sits above the House of Commons. So lots of questions about that, lots of concerns, a huge political gamble for Rishi Sunak as we are likely to be heading into a general election in the next 12 months. Is it going to pay off for him? We're not so sure about that. Also, something else that's affecting markets at intraday is the UK unemployment data. Pretty much unchanged, the labour market. I believe unemployment still historically and universally low at 4.2%, but we have seen this morning that wage growth is outstripping inflation. This is, I believe, the third successive month that this has happened. good thing, of course, if you're a Brit and you need more money in your back pocket. But of course, a headache for the Bank of England governor, because of course, if you've got more money in your pocket, you're going to spend more. Demand therefore goes higher, potentially pushing up inflation, which we know is still quite stubborn at about 6.7. In fact, this is all leaking into markets at intraday. So the FTSE All-Share, Will, is unchanged. Not unchanged, is down at 0.24%. The FTSE 100 is down by 0.39%. In the domestic market, the FTSE 250, that's slightly up at 0.44%. In the currencies market, the British pound is currently trading up against the US dollar by 0.08%, though down against the euro by 0.11%, but up against the Japanese yen at intraday by 0.08%. Well,
Many thanks, Juliana. Always good to have you, as always.
Always great talking to you. Thank you, Will.
Now we go over to the EU, where the defense ministers are meeting in Brussels to discuss their support for Ukraine. The bloc is failing to meet its pledge to supply ammunition to Kyiv, and the defense industry says it can't ramp up production just yet. Joining us with more is Deutsche Welle's correspondent Chipanda Chimbelu in Berlin. Chipanda, what's the latest here?
Well, thanks for having me. Well, earlier this year, the EU had promised Ukraine 1 million rounds of artillery by March 2024, but the bloc has delivered less than a third of that. Reports say that most of those arms that were delivered actually came from military stockpiles. So here we're not talking about artillery that was freshly made after the EU made its pledge to supply Ukraine with more arms. Now, EU countries now have two big challenges. They need to ensure that their own militaries are well stocked, and they also have to provide arms to Ukraine at the same time. So that's one of the major reasons that we're seeing a huge shortfall when it comes to the EU meeting its arms pledge to Ukraine. European countries are essentially trying to balance their own national security interests and the need to help Ukraine defend itself against Russia. And of course, that war has also shown that their own militaries in Europe also need to be better equipped. So what this means for the defense industry is that business is booming, so much that they cannot ramp up production fast enough to keep up.
Interesting there. So what's the outlook for the EU defense industry?
Well, the industry isn't able to keep up or scale production to a level that it needs to, and that's partly due to the fact that the EU's defense industry shrunk after the Cold War ended. Many hadn't expected the continent to see a war like the one being waged by Russia in Ukraine, so the defense industry, of course, now has its work cut out. We may see it expanding over the coming years. The wars that we're seeing now and the heightened geopolitical tensions across the world have raised the demand for arms. So shares of companies like Germany's Rheinmetall are trading at record highs. And that's at a time when they cannot even keep up with the demand for weapons. And they also, the defense industry also appears to be, of course, in a good position to get more from EU policymakers. Right now, the industry is calling for less protectionism through standardization. That would be something that would help open up different EU markets to defense companies. And of course, in exchange to build or revamp facilities to meet current demand, the industry also wants longer contracts for orders from the government. Now, those contracts could be, in excess of 10 years, so say up to 15 years. So, of course, we'll be waiting today to see what comes out of the EU defense ministers' meeting in Brussels. But whatever the decision or decisions, one thing is clear: war and geopolitical tensions are good for the defense industry.
And turning to the markets, so what can we expect today?
Well, European markets opened higher today. The sentiment appears to be positive while investors await U.S. inflation data for October. It will be released later today. And it will help provide investors with an indication of where U.S. Fed policy is headed in the coming months. In September, inflation remained at the same pace as in August at 3.7%. And of course, we will also be looking at some data here in Europe. The EU Statistics Office will be releasing preliminary data for the Eurozone's GDP in the third quarter.
Thank you so much, Iponde Chimbelu, Deutsche Welle's correspondent there in Berlin. Now we move on to the U.S., where stock futures were muted early on Tuesday ahead of a closely watched inflation report due before the bell. Futures tied to the Dow Jones Industrial Average was flat. See, S&P 500 futures, however, was up 0.1%. Nasdaq futures followed with a 0.22% uptick. Now, these moves come as investors ready for the October Consumer Price Index readings slated for release today. Investors believe a hot CPI report may call into question. Investors believe the Fed is done hiking rates, adding that a figure coming in lower than expected could solidify current expectations. Now in Asia, markets rose on Tuesday as investors look ahead to highly anticipated talks between the U.S. and China, as well as more economic data. U.S. President Joe Biden and China's President Xi Jinping will meet in person in San Francisco later in the day for the first time in about a year. Japan's Nikkei 225 closed 0.34% higher, while the Topix index ended 0.37% higher. South Korea's Kospi closed 1.23%. The Kosdaq ended 2.55% higher, snapping a 5-day losing streak. Now in Australia, if we look at it closely, the S&P ASX 200 ended 0.83% higher at 7,006 points, bouncing after 2 sessions of declines. Hong Kong's Hang Seng Index traded 0.17% lower in the final hour of trade, while the mainland China Shanghai Index added 0.31% to close. Next, updates from the commodities market space. To stay with us, this is Business Incorporated. Welcome back. Now we're going to be turning our attention to smartphones and that use in Nigeria. We're seeing the average price of smartphones in the country ranges from about 39,900 naira at the low end to 1.5 million naira at the high end of the spectrum. Ola Shubomi, Ali Balogun, analyst with financial derivatives, joins me this afternoon to share his insights on why this is so. Ola Shubomi, are there these increases in Nigeria are they just limited to Nigeria, or is there a global surge in the price of smartphones?
So there are global surges in the price of smartphones. We have seen the Taiwan semiconductor manufacturing company, they increased their prices by 9%. And so basically what they do is they provide chips for smartphones, which the chips are put in the motherboard, and this powers the phone. So we have seen an increase in the price of these chips. We have also seen the 5G technology, which has been included into the telephones that are just released. So when you look at the consumer demand and expectation for their phones, they expect smarter phones, they expect faster phones, they expect the performance to go up. They expect that these phones that they're bringing into the country can also compete. So when the cost of all this, when it is calculated, the manufacturers can only take some parts of the cost, and this is passed on to the consumers. So there is a global increase in the price of phones. But when you now look at the domestic market in Nigeria, the inflation, we have exchange rates, all these all these are high right now. So when you convert the currency from the dollar into naira, you see that the prices of phones skyrocket, the prices double. So when the prices of phones right now, they've gone up. And if you look at the price of an iPhone, the price of Samsung and other Infinix products, you see that the prices that we had last year compared to the prices that we had this year are not the same. So globally, the prices have gone up. Then locally also, the prices also have gone up.
So yeah, definitely, because we've seen that report from the EIU, which says that we've seen this growth in the number of smartphone users in Nigeria. But at the same time, the report still says we've seen a decline in the use and those who use personal laptops, that's personal computers. Are smartphones now a substitute? Are people now substituting smartphones for PCs or vice versa? It's more like, the more smartphones that are out there, the less subscription for personal computers. What's happening?
Well, on that, we've seen that the phones that are being brought out now, they sort of like have more features that can take off work from personal computers. So it is much easier for the consumers to take the phone while on the road. It is much more heavier to take up your personal computers while you're going out. So I've seen that the technology advancements in the phones are going towards the functionalities of personal computers. So most people tend to take their phones out and leave their computers at home. Then when you look at the world globally, they've introduced tech hubs, which you can see in different states in the US, in the UK, and various countries. So most people, when you have something to do that is very, very urgent, there are tech hubs close to you that you can always stop at to work. We have seen a few tech hubs start up in Nigeria, but we have not seen lots of infrastructure. So I think with the way things are going, there will be decline in the price or decline in the demand for personal computers if we have more tech hubs and the functionality of your phones, if they can do more. But I don't think they are a substitute for personal computers, because when you are trying to analyze data, there is a certain percentage of data that your phone can analyze. There's so much that your phone can do. When you're trying, we have seen content creators come up with different content using their phones. Phones were slowly replacing cameras because they had higher pixels. But when you need the professional shoots for your wedding, when you need professional shoots for your work, you always still go back to the professional way. So we have seen that if we need to do something work, when we have to do something that is very, very tasking and requires a lot of capacity, we still have to go back to personal computers.
Looking at the use of smartphones, we see that, looking at that sharp growth in the use of smartphones, one would think that we should benefit the economy one way or the other. What about local content? What are we looking at in terms of local manufacturing? Even if it's just an assemblage, the putting together smartphones in Nigeria and using the materials that we have here, the raw materials we have here, to put them together. Are there any plans in the offing, in the pipeline, to seeing that we have a lot of smartphone users and we plan to expand that? What are we doing to ensure local production of these phones in Nigeria?
Well, I think ICT has been one of the major focus of the government in Nigeria, and I know there will surely be a plan to move towards that direction as ICT infrastructure and the recent 5G, which was introduced, is currently going on. So I think it will still take a few years before we can start to assemble and produce here locally. But I can see that there are a few technological companies in the country which are making moves towards that.
Thank you so much, Olashibomi Ali Balogun, analyst with Financial Derivatives Companies, for sharing your insights. Many thanks for coming on the program. Now we go over to other stories, where a survey conducted by SBM Intelligence, a Nigerian geopolitical intelligence platform, shows around half of Nigerian workers who earn the minimum wage in the country spend their entire income on food. According to Sheyi Awojulogbe, senior analyst at SBM Intelligence, the government needs to make policies to support civil servants in the country. Ms. Awojulogbe was a guest on our Business Morning show earlier today.
Apart from food, which people identify that as taking a chunk of their income, they also identify the utilities such as rent and electricity bills as taking significant part of their income. And also healthcare and family needs are some of the things that rank high on the spending priorities of Nigerians at this time. As regards the loan apps, we've seen that it is brisk business, and especially from the Federal Consumer Protection Council that is having to deal with these loans and regulate them, especially given the shame practice that these loan companies have adopted in recovering their loans. So there needs to be something done across board. One, to check the prices of food, to check food inflation, to make sure that the prices are affordable, especially as we go into the December season with Christmas and the New Year celebrations, which already over the years we noticed that food prices increase during this period because of increased demand. So, of course, something needs to be done to check food prices, and also something needs to be done to check and monitor the practices of these loan apps, because we see that it's brisk business for them.
Definitely a good move there. We hope the government takes. Now we go over to South Africa, where the employment has risen above the level it was before the coronavirus pandemic struck, as finance and community and social service sectors added jobs. The number of employed people stood at 16.7 million in the 3 months through September, exceeding the number before the pandemic struck, according to data from Statistics South Africa. And this comes as the official jobless rate decreased more than expected to 31.9% in the quarter from 32.6% in the prior 3 months. South Africa's unemployment rate has now been above 30% since the height of the pandemic in 2020, stoked by rolling power cuts instituted by Eskom Holdings and logistics constraints, which have hobbled economic growth. Now, Israel's natural gas flows to Egypt may almost double to reach pre-war levels early next week, as according to a person familiar with Egyptian imports, as safety concerns from the conflict with Hamas ease and a major gas field resumes output. Imports are expected to rise to 650 million cubic feet a day on Thursday, and to the normal level of 800 million cubic feet early next week, from about 250 million cubic feet earlier in November. And that's still according to the sources. And that's a wrap on Business Incorporated for today. Join us tomorrow for another edition. I'm Will Ibang. Thanks for watching.